Hey traders, welcome to Charts and Coffee. Welcome. Happy day 2 of Powell's testimony, otherwise known as Thursday. Great to see everyone as usual. So just a quick nod to the economic calendar here this morning, and you'll see that scroll on down, and we have Fed Chair Powell beginning at 10. Yes, we have ISM, and yes, we've already had unemployment claims. We're going to have a 9:45 final services PMI, but frankly, I don't think there's going to be that much interest in any kind of dramatic reaction to unemployment. I'll show you in a minute. Much more interest in whether or not Powell stays as targeted on the 25 basis point hike conversation. I think there's a lot of, I don't know if it's just confusion or just a lack of basic understanding of what Fed fund probabilities actually communicate. For a brief period of time, there was a fairly significant expectation for rate hikes up to a half point. For the most part, it's clearly been hovering about a quarter point. And you can see here that 97.8% column, that's the quarter point column. We've done a number of free videos back at the Simpler Trading YouTube channel on this very breakdown on this topic. What is interesting is this sort of just teasing either hold, which is ridiculous, right? Anyone talking about a hold is just clearly listening to someone else talk about, hey, there's a probability of a hold, but they're not looking at the percentages. Please don't get caught up in that or distracted. There's not very much chance of a hold. And right now, there's very little chance of a half point hike in March. Doesn't mean that we won't continue to see hikes in March, May, June. So the conversation really has been mostly quarter point in May, quarter point in June, and of course, this quarter point in March. And then we'll see where we end up in July. And the only difference would have been, are we going to be at 100 basis points or 1 full percentage point higher come July, or 3/4? Does anyone think there's a huge difference there? Likely not. What's interesting and what happens after July, right? That is what we're most uncertain about. And of course, there's no way we can make a call on that in March. It's ludicrous to think we can do that. We can't. The Federal Reserve is going to use each data point, like this Friday's non-farm payroll, to either justify their hawkishness or justify their less hawkish behavior, right? We are going to see we've already seen the asset purchases reduced. We're going to see an unwind of the balance sheet. We're going to see rate hikes. This is hawkish. This is tightening monetary policy, period, right? If it's less tight, it's still tightening, okay? All right, so moving forward from that, today's candle on the NASDAQ is the first candle in some time that actually gets me thinking we're right back in the range that for many of you, you might recall, I got us short in. This was something we did in the Sector Secrets Mastery. This is something we did in the options room. This is something we did in the futures room. This is just across the board. And the setup was back in here. And yes, I will look for another opportunity to short. Now, we are in a slightly different environment where there was a little bit more expectation of a possible half point rate hike. Here, we're probably looking a little bit more at the quarter, but I'm not going to make any big decisions until Powell is done and until likely we get the non-farm payroll, in which case, if we seem to find a little bit more footing and move higher, as long as we are below this 200 exponential moving average, we're in the southern hemisphere. We're in the bearish hemisphere. And I'm going to still persist with the plan, which is to wait for the bounce in my zone and start to look for shorts. And I think what oftentimes is confused for people who say, hey, I want to short or I'm bearish, is that they're shorting through all this. No, I think the most important thing to ask anybody who is bullish or bearish isn't what's your sentiment, what's your opinion of the trend. It's where will you engage the market, right? So if someone's bearish, as I am, Doesn't mean that I'm going to engage the market down at 13.6 or even 13.9. I'm waiting for this area, 21 exponential and the 34 EMA wave. So I hope that makes sense. And then, those of you that are fans of, kind of breaking down the index into the sectors, as I like to do, this absolutely opens up XLY, XLC, and XLK, which actually might be better corners of the tech, getting a little bit more specific to the sector to focus on. All right. So with that being said, of course, this show is always about your questions, and let's go ahead and dive into them. All right. So first up, Jack, I opened short puts on DHI. Okay. And Intel. All right. Where they are double red and they have currently shifted to yellow neutral, will I offer any suggestions on managing these trades? I don't have either one of these trades open, Jack, but I will say what I always recommend to my Sector Secrets Mastery folks. Risk is a percentage of how much premium you are willing to risk for the option you bought, and then how much does that represent in terms of loss to the account. Everything comes back to what am I going to risk on this option, and what does that represent as far as a loss in my account. Both of these, well, Intel mostly is on the radar. DHI looks great as well. I just don't have a short yet. We haven't sent out an alert, but they're on the radar. And I do like both. I think basically where you are in from, it would be an aggro level, which is fine, which also goes back to something that we spend a lot of time. It's not fun, right? It's not as fun as talking about a new secret squiggle or talking about a new entry. I know those are both big dopamine hits, right? But the unsexy part of trading, and yet the holy grail, if there really is one, is position sizing and risk management. And I just kind of call that market money math. What's the market money math that you have for this trade? How are you scaling in, right? We don't just enter at an aggro, but we think about aggressive, moderate, conservative. How are you scaling in? What is the total budget for that Intel? What is the total budget for that DHI trade? And then in terms of risk from each trigger, are you willing to let certain entries go while you're still building a position? And those are things that are not uncommon within my trading. So I like the shorts in both. Intel definitely has been on the radar, and we're still watching this one really closely for an alert. What we do know is while Powell is still speaking, bonds are still active. And if bonds are still moving, tech, and of course the 10-year yield, are going to be disproportionately affected and volatile. So I do like Intel at the short. I'd like to get past Powell. And, I hope you're keeping up with some of the free videos that I send out, because this is just really in line with what we've been talking about there today. But I like what's on your radar. And as long as you're looking, basically, really only aggressive, maybe moderately, I think you're fine. A little skin in the game that you just are going to presume is going to take a little bit of heat. Taking heat is really part of trading. And I think a lot of traders who understand heat, that's just a tactical part of what the journey of a trade entry is inevitably going to go through most of the time. You're going to be fine as long as you're focusing on the major trend. And you're going to be fine doesn't mean that it's going to be a winner. I really don't know. I'm going to be joining you in this pretty shortly. But what we do know is if we're wrong, we've predefined where that is. We know what that loss is going to represent. And it's one that we can move on from. That's the most important thing. As far as how can we have access to the Sunday evening Q&A, I'm going to do this right here at the Simpler Trading YouTube channel. If you're a member of the options room, the mastery, or the futures room, I'll send the general notes out. Those should not be confused with the daily notes that I send out only for members or only for my mastery. But that general sort of big picture look at the weekly, that will be in the room that'll be in the alerts. Sorry, the alerts for those rooms. And then the Q&A will be accessible here at the Simpler Trading YouTube channel. Of course, that means Anyone who wants to log in can join me. All right, moving on. Julian, how do you determine entries between futures and options and futures from a risk reward perspective? Julian, I think for a lot of traders, myself included, it's cost, right? What is the initial margin requirement? Is it going to allow me to scale in? Now, 20 years ago, that would have been a really big deal. I only had, X amount of dollars in my account. And if I knew that a particular initial margin requirement was quite high, then I knew that it was probably not realistic to scale in. And the options were oftentimes a better way to not necessarily just control risk, but allow myself to have other positions rather than one or two monopolizing all my capital. So really, it's a personal decision. Luckily at this stage in my career, but I mean, just admit, 32 years later, those aren't as pressing an issue. But yeah, in the beginning, it's going to be account size. What is the initial margin? Will it allow for you to scale in? Might you be better off with a micro or maybe an option from a risk perspective? All right, BLDR is the next question. And I'm trying to fight off a sneeze here. Maybe the coffee will help. 1, 2, 3. Do we have a 1, 2, 3 on BLDR? Okay, so hang on, I'm gonna move some of the million books on my desk. Oh, by the way, gotta highly recommend this one. 7 Lessons About the Brain. I think every single trader should read this. It's a I love books this size. This is one of those books you can read in a weekend, nice and small. And this is, I mean, the appendix starts at, I think it's 120 pages, give or take a few pages. Very, very good read. I've gone through it 3 times now, and I pick things up every time. The other book, if you've read that, by the way, I would recommend Lisa Feldman Barrett. That's the author. Her other book, which is called How Emotions Are Made. If for traders you think emotions don't rule most of what you do, I know everyone here in Charts and Coffee gets it. JOMOs and FOMOs and panic and greed and everything else. Really 2 excellent books, I think, that will help traders fine tune the psychology that would optimize their ability to execute their trade ideas. So very good read. Just loving it. 7.5 Lessons About the Brain. All right. So BLDR, is there a 1, 2, 3 here? I think there's a good continuation 1, 2, 3 that has triggered. That low, let me mention this low right in here actually does not invalidate the 1, 2, 3. It's just irritating, but it's not invalidating. And I think all of us need to know the difference between what's irritating within the life cycle of a trade and what invalidates the life cycle of a trade. That's irritating, not invalidating. So yes, we could call that a 1, 2, 3. My only question is, was it a little on the short side? And it actually was a wee bit on the short side, but it did meet the criteria. If you're unfamiliar with the criteria of this pattern, what you can do is head on over to Google. It's probably the easiest way to find it. Search. For those of you that are wondering, what is Debbie talking about? This 1, 2, 3. Look, Google Countdown Trader, Dow 1, 2, 3, and you will get 2 or 3, maybe 4 articles that we have posted over at countdowntrader.com. And the one that I'm referring to in terms of BLDR and Debbie's question is that continuation variety. All right. So check that out. I think it'll, for those of you who don't know. So yes, as far as, where was the break? I mean, we can see the Darvis, Debbie, you can see the Darvis right there, right around 72.20. That was where the breakout was, 72.20. And then this move after that, whether you looked at the break on the 9th of February or the 18th of February, the 24th, the 23rd, the 22nd, were all within the window of, hey, this is triggered. This is a pullback. But now, no, I mean, this thing's taken off. The train has left the station. A good eye on that 1, 2, 3. Next up, would I kindly explain how I use my VWAP and Z score to confirm trading entries? It's really easy, Lewis. It's support and resistance. Not that dissimilar, the V score. The calculation is galactically different, but the use is very similar. It's maybe comparing a screwdriver to a Phillips head, but if you're comfortable with the visual of a slow stochastic, kind of similar to that. Kind of similar to that. So looking at levels of support and resistance. As far as volume weighted average price is also support and resistance, and probably visually similar to moving averages, right? And I use, again, the calculations are different. Where they're going to land you on the chart in terms of what's a valid actionable level, those are going to be different, but I'm trying to anchor them visually to things that I think a lot of traders are probably already familiar with, especially if you've been following my work, slow stochastic, moving averages. But these, again, the calculations, why they're plotting what they're looking at, galactically different, but that would probably be the best analogy to describe that. Okay. All right. Next up, ZB. Tom, I love that you're looking at bonds. I want to get into bonds. I did not want to do that with Powell. I think bond traders uh, absolutely were out of their minds to gap this market up and rally it. But again, price action is price action. I'm not going to argue that we didn't go hit these highs, but I am still very much bullish yield, which is to say ZN, ZB, IEF, TLT. I want to be long puts or short those markets, just whatever, however we want to position ourselves for lower lows. But I'm leaving this thing alone right now. We knew Powell was going to be impactful to what the perception of upcoming rates were going to be, not just for the near term March, May, June meetings, but going out later into the year. Bond traders really are betting that Powell may not be hiking as much, say 5 rate hikes versus 7. I've heard some people say 2 or 3 rate hikes. Don't listen to the chatter. Gang, the older I get, the more I trade, the more I detest financial television. It's categorically inane and absolutely useless. It's entertainment. Use it as such. Now, having said that, a lot of times conversations about the market, what the market could do, is only happening on television, not in the world of the real. But I think what's more interesting in the last 5 years that I've noticed as opposed to the previous 25 is that retail traders really are glued to that nonsense on television. And they are executing ideas and moving more size than ever, which is great. Hopefully they all get a clue. But if not, I know you all are. So I really don't care what the masses do. Can't help folks who don't realize that there's a game being played, and oftentimes it's at their expense. Yeah. So when I know that there's going to be a high degree of volatility, how do we know that? Powell, right? You see Powell on the schedule, pop a Dramamine and either kick your feet up on the desk or realize that this is going to be a lot wilder a ride. When I know dollar is going to be in play, euro, indices, treasuries, our two choices are, again, just get ready for the ride or just wait. And I'm choosing to wait. I'm choosing to wait. Do I want to be short these? Absolutely. Was that rip higher an aggro short? I talked about what I saw and what I liked in a free video the day that it shot up, so you can get an idea of what I was thinking. But this is a wild market that's still adjusting to what it is that the central bank is going to do. And like I said, that was one of the most bonkers moves I've seen. But what was it reflecting? Hey, we think that Powell just won't be able to hike as much, which I don't disagree with, but there are going to be hikes. So I hope that makes sense. I'm staying away for now, Tom, but I still want to be short. Hey there, Alex. What to do when even a 5-minute chart stops you out, trading micros of the ES? It's very volatile, Alex. So I think, Alex, great question. So let's start with, why are you getting stopped out? When are you executing your trades? Are they between 9:30 and 10 when we're getting that violent expansion within the clearing range once the bell rings? Okay. Are you getting stopped out in the last day or two? Think about what we've been getting the last week. Ukraine, Powell, Bullard, traders jockeying for position around the March and subsequent decisions on rates. So those are things that will let you know that you're sort of walking into a minefield, right? So that's the first thing. Are you acknowledging this environment's very, very different, very, very prickly? Not only do we have kind of a confusing, fuzzy picture on what the central bank is going to do, or what can they do? They want to hike, believe me, and that the data allows them. If we get a strong jobs number tomorrow, watch how quickly this nonsense hold column, and I say nonsense, not my opinion, 2.2%. That's really almost statistically irrelevant. But watch how quickly that disappears and becomes a tiny and probably equally irrelevant half point hike conversation. Yet we're going to see that quarter. So as long as those things are happening, Alex, yeah, it makes perfect sense why intraday it's been really, really difficult. Now, I don't want traders thinking that this market is categorically untradeable. It's not, my friends. It's not at all. Let me leave you with this. And yes, it's a little bit of a shameless plug, but it's also that right now, if you are frustrated, if you're not seeing the market, I am extremely, I don't know if you could even see how nearsighted I am. Even I need corrective lenses, really, really thick ones. Wednesday's about what kind of corrective lenses do you need on your trading right now? You're probably looking at the right thing. It's just fuzzy, right? You just need it to sharpen up. How do you sharpen your focus? You start with a watch list, a properly built watch list. Then you move on to prioritizing trends, not chop. And then you can move on to waiting for the zones that give you the best edge, both in price and tactics in terms of those exhaustion levels. That's what we've been doing, right? So on Wednesday, we're going to talk about what we've been doing in the mastery. A lot of that's been in the futures room. Quite a few of those trades have been in the options room. You all then know we're already, long before Ukraine, long crude oil, long oil stocks. We were long natty gas the first week of this month. Not because I knew Ukraine was coming, because we built those watch lists, we used those tools, we found those levels. Long Coke, long Altria. So the trades are there. They're probably not appearing in ways that, if you need some glasses, are going to be easy to see. So that's what we're going to do on Wednesday. All right. So if things are fuzzy, you're so close, but you need a little bit of fine tuning. Or maybe you just need to say, Rog, forget fine tuning. I need to build a brand new foundation. Come on over. But before you do that, head on over to countdowntrader.com. Get the free indicators, gang. I am not pitching a secret squiggle on Wednesday. That's not about a new indicator. It's not a class. I'm going to show you what I've been doing in my mastery. A lot of you have been asking, and we're going to jump into what we've been doing this year. And hopefully that's going to get everyone on a really good path through the rest of the year. That is my sincere desire. I want to see those of you in charts and coffee in the rooms just kick butt. I want this community just to be supportive and kick butt in this market. Anyways, I'm running over. I've got to get on over to the futures room. Thanks as always for being a part of Charts and Coffee. Caffeinate and dominate. I'll see you tomorrow. Same time, same station.